Everyone is fixated on that $8,000 gold price target. But if you're treating it like a roadmap, you're looking at the rearview mirror. History doesn't repeat itself verbatim, but it rhymes. The real story isn't the price tag, it's the crumbling monetary system. And if you think this is new, think again. The 1970s already warned us exactly where this path leads. Deutsche Bank recently dropped a bombshell report predicting gold at $8,000 an ounce in 5 years. Naturally, the headlines went wild. Investors are salivating, traders are calculating the potential gains, and the gold bugs feel completely vindicated. But here is the trap. Focusing on the number is a massive distraction. If you get caught up in the "how high can it go" game, you're missing the underlying signal. Because let's be clear, $8,000 gold isn't just a forecast of growth, it's a symptom of a systemic breakdown. To understand why this number matters, and more importantly, what it actually means for your portfolio, we have to stop looking at today's charts and start looking at the past. We're going back to the 1970s. Why? Because the structural forces driving the economy today are eerily similar to the decade that redefined the modern financial world. This isn't just a standard market update. It's a deep dive into the cycles that move nations. And trust me, once you see the pattern, you'll never look at your assets the same way again. To understand where we're going, we have to look back at 1971. That wasn't just another year in the calendar. That was the day the financial order of the world was fundamentally ripped apart. On August 15, 1971, Richard Nixon did something that changed everything. He closed the gold window. Overnight, the link between the US dollar and gold was severed. The Bretton Woods system, the bedrock of global stability since the end of World War II, collapsed. It was the birth of the modern fiat era, a world where money wasn't backed by anything tangible, but by the full faith and credit of the government. But here is where most people get the history wrong. Shortly after that disconnect, the world entered the decade of stagflation. We saw prices skyrocketing while economic growth completely stalled. And in that environment, gold exploded. But don't make the mistake of thinking gold surged because it was a high-growth asset. It didn't. Gold surged because the trust in paper money evaporated. When you look at the 1970s, you aren't looking at a bull market for gold. You were looking at a crisis of confidence in the dollar. Investors didn't flock to gold because they were greedy. They flocked to gold because it was the only thing left that held value when the currency itself was being debased. It was a panic-driven flight to the only neutral asset left standing.
Now, fast forward to today. Look at the current landscape. Exploding national debt, persistent fiscal pressure, and a central banking system that is once again operating under extreme constraints. Does that sound familiar? While the 1970s were defined by a struggle against inflation, today we are grappling with a massive buildup of sovereign debt pressure that makes the 70s look like child's play. The mechanism is the same, but the scale is vastly different. Back then, the system had room to breathe. Today, we're hitting a wall of debt that is no longer sustainable under the old rules. We aren't just reliving the inflation of the 70s, we are witnessing the second act of the 1971 drama, where the structural flaws of a debt-based system are finally coming home to roost. But this time, the world isn't just watching from the sidelines, it's fragmenting. And that, as we'll see, changes the game entirely. We are no longer living in the flat, frictionless world of the 2000s. Back then, the mantra was simple: efficiency, speed, and global trade integration. But that era of globalization has been replaced by a new, colder reality: geo-economic fragmentation. If the 1970s were primarily a fight against inflation, today we are grappling with a massive buildup of sovereign debt pressure that makes the 70s look like child's play. Countries are no longer prioritizing the cheapest route to production. They are prioritizing self-reliance. And that shift brings us to a concept that has quietly but violently rewritten the rules of the global financial order: the weaponization of the dollar. Think back to 2022. When hundreds of billions in foreign reserves held within the Western banking system were frozen overnight, it wasn't just a geopolitical event, it was a demonstration. It was a clear, unmistakable signal sent to every central bank on the planet. If you hold your wealth in our system, you play by our rules, or you lose access. That single event sparked a quiet revolution in central bank behavior. They started asking a fundamental question: if our reserves can be turned off with the click of a button, are they actually our reserves? The answer, they realized, is no. That is why we're seeing this unprecedented multi-year gold buying spree. Central banks aren't buying gold because they're betting on a quick price hike. They're not speculators. They are sovereign institutions managing risk. They are buying gold because it is a non-custodial asset. It requires no counterparty. It requires no permission. It cannot be hacked, deleted, or frozen by a foreign power. In a world where trust between nations is at an all-time low, gold has regained its status as the only truly neutral sovereign asset left on the board. It is the language of last resort. And as this fragmentation accelerates, the demand for this neutrality is pushing the market into uncharted territory, which leads us to the most controversial part of this whole story, that $8,000 price target. So, where does this $8,000 figure actually come from?
Is it just a random number thrown out to grab headlines? Actually, no. If you look past the shock value, you'll find this isn't a psychic prediction, it's an accounting exercise. It's based on reserve rebalancing. When analysts run the math, they are asking a simple question. If central banks decided to return to a historical norm for their gold-to-currency reserve ratio, what would the price of gold have to be to balance their books? It's a math problem, not a horoscope. It's an attempt to quantify the structural shift we discussed earlier. But here's the real lesson for you as an investor. Don't fall for the price target trap. Buying gold is fundamentally different from buying a growth stock. It is a non-yielding asset. It doesn't pay a dividend. It doesn't pay interest. When you allocate capital to gold, you are paying a premium. You are paying the opportunity cost of not holding interest-bearing assets like bonds or cash. You are essentially trading yield for certainty. You are paying for the absence of risk. And that is the shift in mindset you need to make. Stop looking at gold as a ticker symbol that you want to pump. Stop chasing that $8,000 target as if it's a finish line in a race. Instead, focus on the allocation. If the world's most powerful institutions are quietly restructuring their balance sheets to account for this new era of fragmentation, the real question is, what is your portfolio's response? The question isn't, when will gold hit $8,000? The question is your portfolio structured to survive in a world where the old rules of safety no longer apply? It's time to stop thinking about the price of the asset and start thinking about the integrity of your entire financial structure. At the end of the day, we need to be clear about one thing. Gold is not a commodity you trade to take profit in the short term. It is a defensive line, a barrier you build in a world that is rapidly fragmenting. Whether the price hits $8,000 or hangs at $2,000 matters far less than the fundamental question of resilience. Does your portfolio actually have the structural gravity to stay upright when the ground starts shaking? The math of the 1970s is rhyming, but the global players have changed. We are witnessing a systemic shift that won't be resolved overnight, and simply chasing price targets is a losing game. So I want to leave you with this. If history is indeed repeating itself, what asset in your current portfolio is going to act as your gold? What is your defensive backbone when the traditional rules of the game are being rewritten? I want to hear your take. How are you positioning your own allocations to handle this new era of volatility? Are you building for growth or are you building for survival? Drop a comment below, let's get into the strategy, and let's keep the conversation going. Stay sharp, stay proactive, and I'll see you in the next one.